Welcome to today's edition of Crypto Catalysts. Today, we bring you the most shocking news that will shake the world of finance to its core. Brace yourselves as we uncover the imminent collapse of the once booming crypto industry. From soaring prices to devastating crashes, the crypto market has experienced it all. But as we delve deeper into the data, we reveal a bleak future for the industry. Join us as we explore the dark side of the crypto world and the potential consequences that lie ahead. Silicon Valley Bank's collapse, a warning sign for the banking industry. The news of Silicon Valley Bank's collapse has sent shockwaves throughout the world. The once mighty bank, which had been a stalwart of the tech industry, has crumbled under the weight of economic pressures and regulatory scrutiny. As the dust settles on this catastrophic failure, the question on everyone's mind is, what does this mean for the banking industry as a whole? The answer is not a simple one. On the one hand, Silicon Valley Bank's collapse can be seen as a warning sign for the rest of the industry. The bank's assets, valued at $167 billion, were sold at a discount of $16.5 billion to First Citizens Bank, a move that highlights the dire state of the banking industry. The FDIC's decision to sell the bank's assets is a clear indication of the ongoing consolidation in the industry, which has been struggling to maintain profitability in the face of low interest rates, increased competition from fintechs, and increased regulation. This consolidation has led to the creation of a banking behemoth, with First Citizens Bank's assets now exceeding $100 billion. While this may seem like a positive development, it also raises concerns about the concentration of power in the banking industry. With fewer players in the market, there is a risk that competition will suffer, and customers will be left with fewer options. On the other hand, Silicon Valley Bank's collapse can also be seen as a unique case, driven by factors specific to the tech industry. The bank's clients included some of the biggest names in Silicon Valley, and its failure is a sign of the challenges facing the industry. The pandemic has hit the tech industry hard, with many startups struggling to survive in the face of reduced funding and decreased demand. Silicon Valley Bank's collapse may be more indicative of the challenges facing the tech industry than the banking industry as a whole. Regardless of the root causes, the impact of Silicon Valley Bank's failure will be felt for years to come. The collapse of such a large institution is a blow to the banking industry's reputation, and it will take time for the industry to recover. The FDIC's decision to sell the bank's assets at a discount is also a reminder that the government is not willing to bail out failing banks indefinitely. The days of too big to fail may be over, and banks will need to take responsibility for their own financial health. The fallout from Silicon Valley Bank's collapse will also be felt by the bank's employees and customers. Thousands of people have lost their jobs, and the bank's clients are left wondering what will happen to their accounts and investments. The sale of the bank's assets to First Citizens Bank may provide some stability, but it also raises questions about the future of Silicon Valley Bank's unique culture and approach to banking. In the end, the story of Silicon Valley Bank's collapse is a cautionary tale for the banking industry. It is a reminder that no institution is too big to fail, and that banks must be vigilant in managing their risks and maintaining their financial health. It is also a reminder that the world is changing, and the banking industry must adapt to survive. Whether this means embracing new technologies, finding new ways to compete, or simply being more transparent and customer-focused, the industry must be willing to change if it hopes to thrive in the years to come. But what does this have to do with the crypto industry? The answer may surprise you. Keep watching to find out how Silicon Valley Bank's collapse could spell disaster for the once booming world of cryptocurrency. The liquidity crisis, is the end near for the crypto market? Bitcoin has been the talk of the town for quite some time now. The world's largest cryptocurrency has been on a roller coaster ride, hitting its all-time high of $64,000 in April 2021 before crashing down to $28,000 in June. The market has been volatile, and investors are uncertain about the future of Bitcoin. As the week began, Bitcoin was testing the $28,000 mark, but experts believe that a consolidation at $25,000 is within the realm of possibilities. The market has remained largely bullish after the Federal Open Market Committee, FOMC, pushed out a relatively tame rate hike. However, Joe DePasquale, CEO of crypto asset manager BitBoy Capital, believes that a correction to $25,000 is still in play. For now, the bulls will want to see Bitcoin respecting $25,000 and consolidating above that level, he told CoinDesk in a note. The success of Coinbase is dictating much of the future price movement of crypto, but no one knows how regulators will rule if all tokens are securities. Coinbase CEO Brian Armstrong noted that they weren't entirely surprised by the SEC notice. "No one knows how regulators are going to rule if all tokens are securities," said Edward Moya, Owanda senior market analyst, in an interview with CoinDesk TV. "The market may have remained bullish, but the end is still near. The bulls will want to see Bitcoin respecting $25,000 and consolidating above that level, but a breakdown of $25,000 could put the brakes on this rally, leading to an apocalyptic scenario." The latest decentralized finance (DeFi) crisis involving protocol Euler finance seems to be coming to a close, but decentralized derivatives exchanges are facing their own liquidity crunch. Liquidity is a big concern in today's crypto market. Without market depth, large orders create price slippage, and extreme price fluctuations capsize traders. One of the most interesting developments in DeFi has been decentralized derivatives exchanges. Perpetual Futures DEX (DYDX) was first to the decentralized derivatives vertical, and by all accounts has done very well. But it's not purely decentralized, combining a hybrid of a centralized order book with decentralized custody. The collapse of FTX was a booster shot of interest, but DYDX's competitors are running out of liquidity, leading to questions if the whole concept can scale. On Friday, Quenta only had $1.27 million in open interest available for long positions on Bitcoin perpetuals, and $450,000 in open interest available on the short side. The situation wasn't much better for Ether, with only $1.64 million in open interest available for longs. GMX was in a better state, but has limited liquidity available for shorts, which can range from just over $1,000 up to around $700,000. In a December report, Token Insight flagged the issue of liquidity as being detrimental to the growth of the sector. But this hasn't affected everyone equally. Perpetual Protocol, another perpetual futures DEX, is still watching its open interest grow. "I think the challenge is that there were not many new crypto traders coming to DEX's post-FTX fallout," its co-founder, Yenwen, told CoinDesk in an email. "But I remain optimistic and believe that derivatives DEXs will become the key players for the next bull run. The lack of market depth may create price slippage, and extreme price fluctuations will capsize traders. The issue of liquidity is detrimental to the growth of the sector, and the end may be near for the crypto market." However, some experts believe that a consolidation phase may be in order, and that Bitcoin is ready for it. Only time will tell what the future holds for the world's largest cryptocurrency. Is it too late to save the crypto industry? Find out the surprising solution in our next segment. The crypto industry on the brink of collapse. The recent news coming out of the crypto industry has been nothing short of apocalyptic. The failure of Silicon Valley Bank and the liquidity crisis facing decentralized derivatives exchanges have sent shockwaves through the already tumultuous industry. And now, with ARK Invest's latest move, the end seems to be near. Cathie Wood's fund has been one of the most active investors in the sector, but her confidence in the future of the crypto industry is misplaced. The recent sell-off is not a temporary setback, but a sign of the impending collapse. The fact that ARK Invest bought $12.6 million of Coinbase coin shares on Friday, after the company received a Wells notice from the SEC, is a sign of the impending doom that is about to befall the crypto industry. The recent volatility in the markets has created opportunities for investors, but it is only a matter of time before the industry crumbles under its own weight. The purchases of Coinbase and Block SQ shares by ARK Invest are a desperate attempt to salvage what little is left of the industry. The long-term potential of the crypto industry is nothing but a pipe dream, and the recent purchases are a sign of the fund's desperation. The failure of Silicon Valley Bank is just the tip of the iceberg. The sale of its assets to First Citizens Bank is a sign of the ongoing consolidation in the banking industry, and a clear indication that the traditional financial system is winning the battle against the crypto industry. The liquidity crisis facing decentralized derivatives exchanges is a further indication that the end is near. Experts have warned about the risks associated with the crypto industry for years, but few have listened. The recent events have shown that the risks are real, and that the industry is on the brink of collapse. The fact that ARK Invest, one of the most respected funds in the industry, is buying up shares of Coinbase and Block is a clear indication of the desperation that has taken hold. The crypto industry was supposed to be the future of finance, but it has turned into a nightmare. The recent events have shown that the industry is not ready for prime time, and that it may never be. The risks associated with the industry are simply too great, and the rewards too uncertain. Investors who have poured billions into the industry may soon find themselves with nothing to show for it. The recent sell-off has wiped out billions in market value, and the end seems to be near. The fact that ARK Invest is still buying up shares of Coinbase and Block is a sign that the fund is either delusional or desperate. The end of the crypto industry may be painful, but it is necessary. The risks associated with the industry are simply too great, and the rewards too uncertain. The traditional financial system may not be perfect, but it is far more stable and reliable than the crypto industry. The recent events have shown that the industry is not ready for prime time, and that it may never be. In conclusion, the crypto industry is on the brink of collapse. The recent events have shown that the risks associated with the industry are simply too great, and the rewards too uncertain. The fact that ARK Invest is still buying up shares of Coinbase and Block is a sign that the fund is either delusional or desperate. The end of the crypto industry may be painful, but it is necessary. The traditional financial system may not be perfect, but it is far more stable and reliable than the crypto industry. The apocalypse is coming, and there is nothing anyone can do to stop it. So, keep the conversation going by sharing your thoughts in the comments below, and don't forget to give this video a big thumbs up if you found it insightful. Be sure to subscribe and hit that notification bell for more in-depth explorations of our city's developments. Until next time, stay curious and stay connected.